Welcome to Markets Now. I'm Michelle Ruck along with Shawn Hackett with Hackett Financial Advisors. Seeing some mixed trade over in the livestock, cattle again seeing pressure, hogs mostly higher, and over in the grains, it's a mixed affair there as well. Corn to the plus side, wheat is mixed, and we're seeing a little pressure over in the soybeans. All right, Shawn, let's talk a little bit about this corn market. We went down, we made some new lows for the move yesterday, but we're back up here. So do we have the bigger acreage numbers all kind of figured in, or what are we trading now moving forward?
Well, what we learned from acreage reports in the past is that we spend about 2 days reacting to them, and then we trade them, and then we go back to weather and other factors. So we absolutely have traded the acreage number, and now I think we've traded bearish weather also into mid-July. I think everyone's pretty much traded that we're going to have a better go of it. Not perfect, but a better go of it into mid-July with cooler, wetter weather. So now, obviously, the trick is, does that continue into August, or do we get a pattern change? Our advanced weather work is suggesting we could get a drier, hotter pattern develop late in the month into August. That's not necessarily a lightning rod for higher corn prices, although grain filling is important, but it could certainly light a fire in the soybean market given the lower acres that we got on Friday. And just as an example, this is not a prediction, but if we were to get an $18 to $20 market on a major crop problem or a major weather market in August, corn isn't going to stay at $4.95. It needs to keep that 3.5 ratio so that South America doesn't plant the entire acreage in soybeans and no corn. So I think that's really where we're at. We got this USDA report coming up here. A lot of debate about exactly how the USA is going to assimilate acres and maybe yield here on corn. And so I think for now, the market's content with what they've done, and they're going to wait for some clues from the USDA report to go from there. And obviously look at the weather reports later in the month. And if we're correct about a warmer, drier pattern starting to get more confidence, pay attention to the soybean market. I think that could be your trigger here for when grain markets might start to turn up here into August and provide another window of opportunity for maybe producers to get a second chance to sell.
Yeah. Of course, like I said this morning, corn is up, soybeans lower. Maybe we're unwinding some of those spreads or putting them back on. But, we got an acreage shock with soybeans, 4 million less acres. Yet we couldn't take out the $14 mark on November beans. What is it going to take to get us above that level, do you think?
We need hot, dry weather forecast for August, or as I do not believe we're going to get over 14.
Okay.
There's too much supply in Brazil. They're going to plant too many acres in the next crop cycle. El Nino weather pattern, right, which is coming up here for the South American growing season, tends to produce big soybean crops. So, if we're going to really take that out and say we're going to do something substantially more than that, we need a sufficient shortfall here to offset. Because remember, if we get soybeans really rocking and rolling here before planting season in South America, they're just going to continue to plant more of that Amazon every year that they seem to do. They're just going to plant more of it. So we got to be very careful not to give South America too bullish of a signal so that we're buried in soybeans, come the first half of 24.
Absolutely. So what do you think, though, for the WASDE next Wednesday? Will USDA make yield adjustments this soon? Sometimes, they slow step this thing.
They do tend to slow step it. I kind of feel as low as the crop ratings have been for corn specifically, I think it would be reasonable to suggest they might knock it down 1 to 2 bushel to the acre. I don't think they'll be willing to do much more than that, especially with the improved weather we've seen. Although crop conditions did not improve too much in the last week, I think reasonably, they might come down a bushel or acre, or two. Does that mean much? I don't think so, but I think, that's probably what I'm expecting to see. With soybeans, I find it really hard pressed why they would do anything to yield at this point. You don't hurt crop yields in soybeans in June. We're getting better weather here in July. Everything says we could still have a good trend line yield crop. I don't see any reason why they would mess around with the soybean yield. Of course, they're going to have to adjust acres and ending stocks and try to figure out where they want to be with all of that. But I think if we're looking for an acreage, a yield adjustment, I think corn we could get a modest adjustment, but not much.
Okay. I know there's no direct correlation with crop conditions, but you've got 67% of the corn acres in some level of drought, and I think about 60% of the soybean acres. So, obviously that brings that into question. What about this wheat market? We did have a nice rally yesterday. Was that all corrective in nature, or are there some weather concerns that we're starting to see crop into that market?
Well, certainly, it was corrective in nature. We did get some apparently exciting news, or if you call it exciting news, about some nuclear power plant issue in Ukraine and what's going to happen, and
Right.
more. But yeah, I don't know how to discount any of that. I just say whatever, right? I mean, I don't know how to forecast any of that. I don't think anybody does. But when I am looking at overall supply, let's keep three things in mind. First of all, spring wheat in Russia had a very unfavorable pattern this growing season, and estimates are they're going to be down 10 to 15% from last year. And the winter wheat crop in Russia is going to be down approximately 15% from last year. So the big issue for the wheat market has been Russia's been willing to sell anybody, anyone, anything all the time and undercutting the market for months. If they somehow back away from that because they're going to have less for sale in the upcoming season, which they are going to have less, then that's how you get the wheat market to start trading something differently than we're going down for the last 16 months like we've been going down. The other thing that's of interest is, even though the weather has improved for the U.S., generally speaking, the Canadian prairies where they grow spring wheat has actually gotten worse. And it
Definitely.
does not look like it's going to get any better at a very important time for spring wheat, and some heat's going to start coming in. So we could be losing significant amounts of potential supply out of the Canadian prairies, and maybe even carrying over into the northern plains here in the U.S. Another place where high quality wheat, could be coming down in supply, and even what appears to be some pretty heavy rain and heat coming into the KC wheat areas, we could be losing quality. So when you put all this together, I think there actually is a pretty good, solid supply side story for a credible tradable rally here in the wheat market going into the fall, geopolitics notwithstanding.
And the cotton market certainly looks like we should be somewhat supply bullish, but that market's no runaway here. Is that just some of these demand concerns because of the economic situation, or what?
Yeah, I mean, we know that cotton is one of the most economically sensitive markets in agriculture. When you look at the chart pattern, we've been trading a very tight range for months upon months upon months. We call it the EKG of a rock pattern, where just nothing's going on, even though supply issues are coming up, hot, dry weather in Texas, acres coming down. But then demand, we're worried about recession, more rate increases from the Fed, and it's just quietly going sideways. The history of those kinds of patterns is they tend to eventually lead to some kind of an upside surprise. Not every time, but oftentimes they lead to an upside surprise. And I think if we remain hot and dry in Texas for much longer, and it looks to me like we are going to do that, I think the supply side of the equation is going to get the upper hand here, Michelle. And I think we need to put some weather premium into the cotton market. And so I'd be looking for this very tight range to break out on the chart as a signal that we might be ready to trade something more than sideways trade. The oats market, for example, was a great market that had a pattern just like this for months, going sideways. And then finally, the supply side took over, and we've had this wild spike trade in oats here over the last, few weeks that surprised everybody, and is now, in hindsight, pretty obvious that was going to happen. So I kind of feel that this market is a sleeper. No one's paying attention to it, but I think we might be ready for some kind of an upside trade that producers would definitely want to take advantage of. If we get it, it'd be a good selling opportunity.
You bet. And let's lastly talk about this cattle market, because second day where we're down, we made new contract highs yesterday in the feeders, and even the day before that in the live cattle futures. Are those reversals, or is this just, again, one of these healthy corrections in this big bull market?
All I can say, Michelle, technically, if you look at, for example, feeder cattle are trading at the highest premium to the 200 moving average since the early 1970s. If you look at relative strength, if you look at slow stochastics, MACD indicators, everything is at an historic overbought condition. That by itself doesn't mean the market has to come down. It just means that the market is extremely overextended. And I understand, we're in an historic situation of tight supply, and that tight supply is legitimate and it's not going away. But a market that tends to get this stretched and typically will find some reason to see liquidation, to see a significant correction out of nowhere and surprise the marketplace here. Once again, it's demand modulation is the name of the game here in the cattle market. And I keep feeling that, we're going to get one of these surprise corrections. And I've said this before and it has not turned out to be correct. But if I'm a producer and I'm looking at these prices that have been working higher and they're at this kind of an historic overextended position, I just feel taking some of that money home on the farm is the right way to manage your risk at this moment in time.
Yeah, and we may be seeing a little hedge pressure here, to your point. All right, thanks for joining us. That's Shawn Hackett with Hackett Financial Advisors and Markets Now.